Welcome back to your CPA Quick Review. Today we're simplifying one of the most tested topics on the CPA exam, investment accounting. By the end of this review, you'll know which accounting method applies, where gains and losses are reported, how the equity method works, and when consolidation is required. Every investment question begins with one simple question: how much of the company do I own? Section 1. The ownership decision tree. This is always your starting point. If ownership is less than 20%, the investment generally uses the fair value method. If ownership is between 20 and 50%, the investment generally uses the equity method because the investor usually has significant influence. If ownership is greater than 50%, consolidation is required because the investor has control. Think of ownership like a relationship. Less than 20% means you're simply an investor. 20 to 50% means you have influence. More than 50% means you're in control. Remember, ownership percentage is only the starting point. Even with less than 20% ownership, the equity method may apply if significant influence exists through board representation, participation in policy decisions, or management involvement. Section 2. Debt securities versus equity securities. Next, ask yourself, am I investing in debt or equity? Debt securities have three classifications: trading, available for sale, and held to maturity. Equity securities generally follow one primary rule: fair value through net income unless the investment qualifies for the equity method or consolidation. Think about your intention. Trading means I'm buying to sell. Trading securities are reported at fair value, and all unrealized gains and losses go directly to net income. Memory trick: trading equals earnings. Available for sale debt securities mean I might sell later. They are also reported at fair value, but here's the CPA exam's favorite twist. Normally, unrealized gains and losses go to OCI, not net income. However, if there's a credit loss, the loss is split into two buckets. The credit loss portion goes to net income, while the remaining decline caused by market conditions or interest rates goes to OCI. Think of two buckets. Credit problems go to net income. Everything else goes to OCI. Here's a quick example. Suppose the amortized cost is $100,000 and the fair value falls to $85,000. The total decline is $15,000. If $10,000 of that decline is caused by expected credit losses, record $10,000 in net income using an allowance for credit losses. The remaining $5,000 is reported in OCI. That's one of Becker's favorite testing points. Held to maturity debt securities mean I'm never selling. Since the company intends and is able to hold them until maturity, they are reported at amortized cost using the effective interest method. Ignore unrealized gains and losses because fair value no longer matters. Memory trick: trading equals net income. AFS equals OCI. HTM equals amortized cost. One small exception is the fair value option. Instead of using the normal accounting method, a company may elect to report certain eligible financial assets, such as available for sale or held to maturity debt securities, at fair value through net income. Think of the fair value option as overriding the normal rules and sending all fair value changes directly to net income. The fair value option is elected when the financial asset is first recognized. Section 3. Investment impairment. Since we covered impairment in detail in the impairment video, here's the quick refresher. Trading securities already report fair value changes in net income, so there is no separate impairment calculation. Held to maturity debt securities recognize expected credit losses through net income using an allowance for credit losses under CECL. Available for sale debt securities split the loss into two buckets. Credit losses go to net income. Everything else goes to OCI. For most equity securities measured at fair value, unrealized gains and losses already flow through net income, so there is no separate impairment calculation. Section 4. The equity method. The equity method is generally used when ownership is between 20 and 50%, and significant influence exists. Think of it as owning a small piece of another company. When that company earns money, your investment becomes more valuable, so increase the investment account and recognize your share of income. When the company pays dividends, you're simply receiving part of your investment back. That's why dividends are not dividend income. They reduce the investment account instead. The most important formula is beginning investment plus share of net income minus dividends equals ending investment. One exception is a liquidating dividend under the fair value method. Since it represents a return of investment rather than earnings, it also reduces the investment account instead of increasing dividend income. Sometimes you pay more than your share of the investee's book value. Part of that excess may be assigned to assets and liabilities recorded at fair value, while the remaining excess represents goodwill. Under the equity method, goodwill remains embedded within the investment account. Section 5. Consolidation. Once ownership exceeds 50%, stop thinking like an investor. Start thinking like one company. Consolidation treats the parent and subsidiary as a single economic entity. That's why 100% of the subsidiary's assets, liabilities, revenues, and expenses are reported, even if the parent owns only 80%. The remaining ownership is reported separately as non-controlling interest within equity. When control is obtained, use the acquisition method. Record the subsidiary's identifiable assets and liabilities at fair value on the acquisition date. Any excess of the purchase price over the fair value of identifiable net assets becomes goodwill. A helpful mnemonic is CAR in big. CAR stands for common stock, additional paid-in capital, and retained earnings, which are eliminated. IN stands for investment account and non-controlling interest. BIG stands for balance sheet fair value adjustments, identifiable intangibles, and goodwill or gain. Section 6. 30-second exam day recap. Less than 20%, usually fair value, 20 to 50%, equity method, over 50%, consolidation. Trading, net income. Available for sale, OCI, held to maturity. Amortized cost, trading impairment, already in net income. AFS impairment, credit losses to net income, everything else to OCI. HTM impairment, CECL through net income. Equity method, beginning investment plus income minus dividends. Consolidation, think one economic entity. If you remember only one thing from this review, remember these 4 questions. How much of the company do I own? Am I holding debt or equity? What is my intention? Sell soon, maybe sell later, or never sell. And finally, where do gains and losses belong? If you answer those 4 questions first, the accounting usually falls into place.